You finally did it. $100,000 invested. And you know what happened the day you crossed that line? Nothing. No confetti, no phone call, your bank app didn't even notice. But here's what nobody tells you. The moment you crossed 100K, something invisible flipped. Your money quietly became a second worker in your house, and it never sleeps. At a 7% return, $100,000 earns about $7,000 a year on its own. That's more than a part-time shift at Tim Hortons pays for doing nothing. Charlie Munger famously said the first 100K is the hardest part. What he didn't explain is what comes after. And after is where most Canadians quietly blow it. In this video, I'll show you 7 mistakes people make right after 100K. Mistake number 4 is the one that quietly cost Canadians over $500,000. Not a typo. So before you touch a single dollar of that portfolio, stick around because the rules you used to get here, they just changed. Every single one of them. Here's exactly what you're getting today. 1. The real math of how fast 100K turns into 200K, 500K, and eventually $1 million. 2. The invisible shift that breaks most investors psychologically right at this milestone. 3. Exactly where your money should sit between your TFSA, RRSP, and FHSA once you're at this level. 4. The 7 mistakes. And 5. A number at the end that might mean you never have to invest another dollar again. Yeah, you heard that right. If we haven't met, I'm Jay. I make videos that help regular Canadians keep more of their money, pay less tax, and get to freedom faster. Quick heads up before the numbers start flying. This is not financial advice. Always do your own research. Cool? Cool. All right, let's talk about why 100K changes everything. Because here's the thing. 100,000 isn't just a nice round number. It's a physical tipping point in the math. And once you see it, you can't unsee it. Back in the 90s, Charlie Munger told a young investor, "Don't screw around. Scrape together your first 100,000 any way you can. After that," he said, "you can ease off the gas." Why 100K? Because early on, your contributions do all the heavy lifting. If you save 500 a month, that's 6,000 a year. Your returns on a small balance? Pocket change. But at 100,000, the math flips. Your portfolio now generates roughly the same as your contributions. You've basically hired a clone of yourself who works for free. Think of it like a snowball at the top of a hill on a Canadian winter day. The first few rolls, you're doing all the pushing. Then, gravity takes over. There's an old shortcut called the Rule of 72. Divide 72 by your return. At 7%, your money doubles roughly every 10 years, without you adding a cent. Here's the proof. Saving 500 a month at 7%, your first 100K takes about 11 years. The second 100K? About 6, nearly half the time. Let me say that again because it matters. 11 years of grinding for the first 100,000. 6 years for the second. Same effort, same contributions. The snowball did the rest. So, the obvious question, how long until 200K, 500, a million? I ran the exact numbers, and one of these milestones will surprise you. Let's set the table. You've got 100K invested, you're adding 1,000 a month, and we'll assume a 7% average return. Boring index funds, nothing fancy. First milestone, 200,000. At this pace, you get there in roughly 4.5 years. Remember, the first 100 took most people 7 to 11. 500,000. That lands around year 13. And here's the wild part. By then, your portfolio earns around $35,000 a year all by itself. $1 million, roughly year 21. Start at 35 with 100K and you're a millionaire in your mid-50s on a completely average salary. Notice the pattern. The gaps shrink. Each 100,000 shows up faster than the one before it. By the end, you're stacking a new 100K every year and a bit. But I have to warn you about the middle, years 3 through 12. Finance nerds call it the messy middle. It's boring, nothing feels like it's happening. And the boring middle is exactly where most people quit. They stop contributing, chase a hot stock, or cash out for a truck. The snowball melts on the driveway. Before you open your investing app to check where you're at, hold on, because there are three levers that can speed this timeline up or wreck it completely. Lever 1, contributions. Every extra 100 a month cuts months off the timeline. Lever 2, returns. You can't control them. Stop trying. Lever 3 is the silent killer, fees. A typical 2% mutual fund fee versus a 0.2% index ETF can cost you well over $200,000 on the road to a million. But fees aren't what breaks investors here. This next thing is. Quick reset if you're just joining. You've crossed 100K. The compounding math is on your side. And now we're at the part nobody warns you about. Here's the shift. Below 100K, your savings drive your portfolio. Above it, the market does. And that changes how it feels to check your account. Say the market drops 2% on a random Tuesday. That's $2,000 gone from your screen. 2 months of contributions, erased before lunch. You did nothing wrong. This is where people crack. They see a red month wipe out a year of saving, panic, and sell, locking in the one loss that was never real until they clicked. But flip it. On green days, your portfolio can earn more before breakfast than you do at work all day. That's not a glitch. That's the whole point of investing. So here's the rule after 100K. Zoom out. Check quarterly, not daily. Your job title changed. You're not the engine anymore. You're the pilot. Pilots don't panic at turbulence. Before 100K, your savings rate was 90% of the game. After it, your behavior is. The investors who win from here are the ones who do the least. But doing less doesn't mean doing nothing. Because right now, where your 100K is sitting could be quietly leaking thousands a year to the CRA. Let's plug that. Here's the honest truth. Most Canadians don't build 100K in one tidy account. It's scattered. Some TFSA, some RRSP, a group plan at work, maybe cash lying around. Someone in this comment section has $100,000 sitting in a checking account, earning nothing. If that's you, this next minute might be the most valuable of your year. Start with the TFSA. For 2026, the annual limit is $7,000. But if you've been eligible since 2009 and never contributed, your total room is $109,000. Read that again, $109,000 of room. Your entire first 100K could be growing completely tax-free. Every dollar of growth, every withdrawal, the CRA never touches it. Next, the RRSP. You get 18% of last year's income up to $33,810 for 2026. Best used in your higher earning years for the tax refund. Now the pro move, asset location. Your highest growth investments belong in the TFSA, where gains are never taxed. U.S. dividend funds often fit better in the RRSP. Interest earners stay sheltered too. Buying your first home someday? The FHSA gives you $8,000 a year, $40,000 lifetime. Tax deduction going in, tax-free coming out. It's the only account that double dips. Only once your TFSA, RRSP, and FHSA room is genuinely full should money spill into a regular taxable account. For most people at 100K, that day hasn't come yet. One more thing while you're in there. Your mix has drifted. If stocks ran up, you might be riskier than you planned. Rebalance once a year. Set a calendar reminder. Done. All right. Accounts optimized, machine humming. Now the part I promised at the start. The 7 mistakes, including the one that cost over $500,000. Mistake 1. Getting cocky. You turned index funds into 100K and suddenly a voice says, "Imagine if you picked the winners yourself." That voice is expensive. Studies keep showing most stock pickers underperform the plain index over time, and that includes the professionals doing it full time. The strategy that got you here still works. Don't fire it. Mistake 2. Sitting in cash waiting for the crash. It feels smart. It feels careful. Meanwhile, inflation eats your pile like it eats your grocery budget. Time in the market beats timing the market. Missing just a handful of best days over a couple decades could cut your final balance dramatically. And those days love to hide right after the worst ones. Mistake 3. Watching your portfolio like it's the third period of Game 7. Daily checking leads to panic selling. We covered the fix. Zoom out. Quarterly. Mistake 4, the $500,000 one. It sounds harmless. It sounds like this. I've hit 100K, compounding will handle it now. I'll stop contributing and enjoy life a little. Run the numbers. 100K left alone at 7% for 21 years grows to about $414,000. Nice. But keep contributing that $1,000 a month, you cross 1 million in the same window. That single decision, keep contributing or coast, is worth roughly $586,000. Mistake 4 costs more than a house. Well, maybe not in Toronto. That's 4 down. The last 3 are sneakier. They don't show up in your portfolio at all. They show up in your paycheck, your paperwork, and your plan. Mistake 5, lifestyle creep. You hit 100K, feel rich, and the spending quietly rises to meet the feeling. New car, bigger place, more takeout. The danger isn't one splurge, it's the permanent upgrades. Every 500 a month of new lifestyle is 500 not compounding. That's the second 100K, gone before it existed. Mistake 6, ignoring the paperwork. At 100K, you're officially worth protecting. No will, no named beneficiaries on your TFSA and RRSP, and your money gets stuck in probate. Naming a successor holder or beneficiary on your registered accounts takes 10 minutes and can save your family months of legal mess and real money. I made a whole video on this, the tax bomb one. It's linked below. Mistake 7. Investing without a finish line. If you don't know your number, you can't know if you're ahead, behind, or already done. You're just accumulating anxiously. The rough shortcut is 25 times your annual spending. Spend $40,000 a year, you need about $1 million. Suddenly, that 21-year timeline isn't abstract, it's your countdown. Quick recap. Don't get cocky, don't hoard cash, stop staring, never stop contributing, cap the creep, do the paperwork, know your number. Screenshot this if you need to. Now that one last idea I promised, the number that might mean you never have to invest another dollar. It's called Coast Fire, and the math is a little ridiculous. Coast Fire works like this. You invest hard, early, until your portfolio can grow to your retirement number on its own. Then you stop. You just coast. Here's the ridiculous math. 100,000 at age 30 at 7% with zero new contributions, it becomes roughly 1.07 million by 65. You never add another dollar. Now the caveats. That's before inflation, it assumes average returns, and you still need to cover life along the way. Coast Fire is a milestone, not a retirement plan on its own. But here's what it really means. At 100K, you've bought something most people never get. Options. Take the smaller job, the year off, the slower lane to the cottage. So your next moves. 1. Automate your contributions so mistake 4 can't happen. 2. Check your account locations this week. 3. Calculate your number tonight. 4. Then close the app and live. Not at 100K yet? I made the exact roadmap, the first 100K in Canada video. Already passed it? Watch how much you actually need to retire here. Both linked below. And drop your province in the comments along with roughly where you're at. Ontario, Alberta, BC, wherever. I'll tell you which account you should probably be maxing next. The first 100K is the hardest thing you'll ever do with money. Everything after it is easier, if you get out of the snowball's way. See you in the next one.